Good morning, everybody. Welcome to our Thursday questions and answers session, where we'll be discussing our latest analyst research around a specific company. And today we're talking about Redefine. We're about 24 hours away of knowing who's going to govern the country and how that'll happen. And I think that'll have an impact on share prices. Obviously, we're keeping a close eye on interest rates to see what companies like Redefine will do into the future. But Fiso has some details and some insights for us, and we're looking forward to sharing that with you. Thank you, Fiso.
Thanks, Sorrel. Good morning, everyone. Like Sorrel mentioned, my name is Fiso Mboto, and today I'll be taking you through some of the highlights from our Redefine company update report. So just to start on the summary side of things, we have maintained our buy recommendation on Redefine with an intrinsic value of 461 and an upside of about 22% when the report was released. They did come up with their first half results. We think they were a decent set of results considering the current operating environment. And they haven't breached any of our bounds from our initial investment thesis, which makes us stand a little bit confident on our buy recommendation. We have seen, though, that there has been a bit of a recent drawback in performance, not only in Redefine, but in the property sector as a whole, over in the general market. And that has opened upside on Redefine since the last report, primarily driven by economic uncertainty around the voting period, pushing the bond yields up. As Saul said, we're a few hours away from knowing what's actually going to be happening with the government, and that should impact performance. But what they did make us see is that impact of uncertainty, impact on yields, as well as impact on the performance of Redefine, satisfied that directional relationship between bonds and property performance. And it, at this point, positions Redefine to have some upside potential, as well as the property sector as a whole. I think the things that would change our mind, we like to separate them into exactly two. The first being a deterioration in property fundamentals, and particularly in vacancies as well as reversions. Vacancies falling below our outline levels, so we outlined that in the report, as well as reversions going lower than the worst level in the last 5 years. So that includes the COVID period. And the way that we have put our line in the sand together is we want to see whether demand has improved for property spaces, as well as if it has improved past that COVID-19 period. And then the other point would be an outlook to change in government bond yields increasing from current levels. So current levels are well above 2 standard deviations from the long term. And if they move a little bit closer and above 3 standard deviations, which should be at about 12.83, then we would start to worry and have a rethink at where our initial investment thesis is and where we expect Redefine to perform. But we haven't breached any of those 2 points at this point in time, which helps us stand a little bit on a better footing when it comes to maintaining our recommendation. In terms of yields and performance, I just want to touch a little bit on these 3 charts. They're interesting. They give us a little bit more insight. So what we've seen is that since our last report, which would have been at the end of January, yields have expanded approximately 83 basis points. And the impact of that has been a slowdown in performance. And we've seen it throughout the market and not in just Redefine alone. Thing I like about that top left chart is it's a little bit difficult to see the point from the last company update report, but you can sort of see that it's somewhere in the center there. But the latest one has seen a pullback in performance, not necessarily as a direct impact of the yields going up, but more so an increasing uncertainty, which does have an impact in general sentiment and the impact of property sector as a whole. And that's nice because it sort of speaks to the relationship that I'm speaking to between the performance of property as well as the yields. And when you plot it into a nice line chart over the last 10 years, contrasting the yields along with valuation multiples, you can sort of see that the push-pull relationship actually positions us to be a little bit more confident about our stance in Redefine. Given the current yield levels and where we would expect that valuation multiple to be. It's currently just above 8. We anticipate it to move between about 9 and 11 times. And on a weighted average basis, it still pushes our upside potential more so towards the positive than it does the negative. I think I like the chart on the right there because it gives us a nice performance contrast over the last 12 months, comparing Redefine, the SAPI as well as the all share. And as you can see, I'm looking at that black line which represents the SAPI. or the South African listed property sector. You can see that there was a good bit of run towards the end of 2023, that last quarter, primarily driven by sort of improving sentiment around the property sector. And we've seen that as well. If you're looking at that cyan/blue line, Redefine also started to have a good pickup in performance towards the end of the year. Both Redefine doing better than the All Share as well as the SAPI over the last 12 months. We have seen a bit of a pullback in performance since the beginning of the year, but that's been primarily driven by increasing levels of uncertainty as we move towards that voting period. But that may come to a bit of a conclusion after we hear what's going to happen tomorrow with our government. Then I like these three charts as well because they give us a little bit of context on where we expect yields to go and the impact on the valuation multiples, as well as our stance on Redefine. So if you look at that top right chart, it just takes the headline inflation, which is the red line, core inflation, which is the green line, has that 3 to 6 SOB target range of inflation, as well as the repo rate. So the SOB did draw its line in the sand at the midpoint of that 3 to 6% range of about 4.5, particularly for that red line, which is currently at about 5.21. You can sort of see that it's a little bit far from that 4.5 sweet spot that the SOB is looking for. And all that means is that it may be pushing out cuts, but the upside potential still remains in the property sector, and specifically here in Redefine. And the reason why we say this is if you look at the bottom chart, the bottom left chart, the one that's in blue, you can see that the yields are still at very high levels compared to history, and we anticipate a correction there. The translation is actually to the right-hand chart, where when you're looking at the last 5 years for the price to funds from operations multiple, it almost looks like it's just fairly valued. But given our stance and where we see the yields going, as well as where we see the property metrics being vacancies and reversions going for Redefine, we actually anticipate that to go further up as high as at about 11 times, which makes us comfortable in our stance of a buy recommendation and the upside potential we see in Redefine. Just want to touch a little bit on the results quickly. They had their first half results. We thought they were decent, and the core metrics are still within our investment thesis bounds, which is why we haven't changed our call on Redefine. Still want to touch on a couple of main points there. We have the distributable income per share up about 6%, dividends per share about flat. The payout ratio, which is one of the most important reasons to really get into these property guys, still at 80%, which is at the lower end of that 80 to 90% target that Redefine has. But we anticipate that by the end of the year, since these are only first half results, it should move closer to about 85%. We did see that the interest cover ratio did come down a bit to 2.2, but it's still above that rule of thumb of 2 times, as well as the covenant. So we're still comfortable at where the interest coverage ratio is. And we did see a bit of an uptick in that loan to value. And it was primarily driven by that acquisition of the Mall of the South. It is above that 39 to 41% target range, but I have some comfort, or at least got some comfort from the call, that management does anticipate to bring that LTV down into the target range in the medium term. So we'll see some improvement in the second half of the year. I think when you look at the bottom, just in terms of those metrics that we like to look at, occupancies and rental reversions, I think sort of the bigger picture there is that in terms of occupancies, they have come down a bit on a portfolio basis. Retail as well come down quite a little bit. But I'll speak to that. When I look at the charts on the right. You can sort of see that in general, specifically, core retail is doing fine. It's just the impact of multi-related spaces, as well as some office vacancies, that look like they're pulling that occupancy levels down. But the nice thing is that we did see that office occupancies did increase. I think it speaks a little bit to the quality of office assets that Redefine has. And then we did see a bit of a pullback from industrial there, but I think when it comes to demand, we like to look at rental reversions. I like to look at rental reversions. It speaks a little bit to how the demand is looking. And on a portfolio basis, it is still negative, slightly less negative than before, but negative nonetheless. Got retail at minus 0.5, sort of doing better, but still negative. The office levels of reversions aren't a big surprise, mostly because office is facing more of a structural issue across the sector. It's not really a Redefine specific issue. And then we had industrial, and I wouldn't have expected anything less than positive reversions at 4%. Think I'm just only going to speak to one chart on the right, particularly the retail chart. We've already spoken about where office is, the structural change in demand. But what's important to see there is that when we're looking at core retail, vacancies are actually only at 4%. It's only when you consider the office, which you would anticipate to see office spaces, even when you're at a mall, where they have the vacancies that are about 28. And then you've got that motor-related vacancies, which is primarily just your showrooms and your car dealerships up at about 40%. So when we exclude those two, sort of see that the actual core vacancies are doing quite fine. Then you've got office there, which is fluctuating but doing sort of okay. I think we anticipate that it should get a little bit better in the second half, or at least in the medium term. I think we're coming to a point where it's starting to stabilize the vacancies in office space. I mean, and the nice a light at the end of the tunnel for Redefine specifically is that a good portion, a large portion of the office exposure is actually in quality, premium and A-grade office spaces. And then you've got the industrial vacancies as well, sort of fine. Not too much comment on there, but it has been a very well-performing subsegment of property in the last couple of years. I like these charts as well. They give us a little bit of context and color of how these metrics have actually changed in the last 5 years or gotten better. When you're looking at that loan to value as well, currently it's at about 42.6. We expect it to come down to below 41%, or at least improve in the medium term, particularly in the second half, as management is sort of guided for us. Interest cover ratio still above 2 times and above its covenants, so we're still happy about that. And we've already spoken about the retail vacancies, where they're actually primarily driven by office spaces within the retail space, as well as some motor-related vacancies, which would be your showrooms, because those are particularly big. And when you have your tenants coming out, the spaces open up quickly, and it does impact the retail vacancies. Then we got industrial. Seemed like it did have a bit of an uptick, which it did, but industrial vacancies are still sub 5%, which is good in 2023, and we expect that to improve a little bit more as well in the full year of 2024. And then we've got office vacancies as well, then coming to a stable point, but we'll have to see what actually happens to those vacancies and an improvement in demand, more so in the second half of 2020 or second half of FY24 for Redefine. Then just in terms of reversions, again, sort of painting a similar picture that there is a move towards a better move towards improvement or better position in reversions, but a negative number is still negative. We've seen that retail reversions are moving towards positive territory. They're currently at about a minus 0.5, and we would anticipate seeing them move towards positive in the second half. Office reversions as well, coming to sort of a stable point, and then we've got industrial reversions being the only ones in the positive at the moment, but we wouldn't expect any less given that it's been a well-performing subsegment of property. When it comes to valuation, we still maintain our buy recommendation with that intrinsic value of 461 with that upside of 22%. I think when you look at the longer term period, now we just look at that performance table there. If we look at periods longer than 1 year, so the 2 year, 3 year, 5 year, 10 year, you can sort of see the property hadn't been doing particularly too well there. But as you've seen in that total return chart I showed before, that over the 1 year or the 12 months, property has been doing quite well relative to the OZ, as well as Redefine itself has been doing quite well relative to its index, or at least the SAPI at this point. We have spoken that the performance in the shorter term periods have been impacted more so by most recent volatility, more so in a bit of a dampening in sentiment in the property sector, as well as volatility driven by sort of uncertainty in what's actually going to happen in the economy, driven by that voting period. But we anticipate that after get some clarity on what's actually going to happen to our government probably tomorrow, where sentiment is actually going to be pushing in terms of positive or negative, as well as how that's going to impact our current stance on Redefine going forward. And then again, just to touch lastly on the price to funds from operations multiple at the bottom again, it does look like in the 5 year term, it's about fairly valued, or at least at the average. But we anticipate that that multiple to go up as high as 11 times. You can see in a bull case scenario, which opens up the amount of potential upside that we can actually expect from Redefine. And even when you're looking at our least optimistic, or at least our bear scenario, we still have some upside there. So it skews the upside on the investment case as a whole, on the positive, which is good for us, and makes us feel a lot more firm and comfortable in our current stance and buy recommendation for Redefine. I think that's it from my side. I'm just gonna hand over to Sean to take you through the technicals at this point. Thank you.
Yeah, good morning, Ori. Yeah, these are great presentation, very comprehensive. Thank you very much. Yeah, looking at the chart here of Redefine, yeah, it's very, very positive from FISA, but also you look at the charts, you can see the share price is trading just above its 21-day moving average. That's at the red line, as well as its 200-day moving average. I call it like a purple line, but it's trading just below its 40-day moving average, is a green one. So the way I see it is the long-term trend is bullish. The medium-term trend is still neutral until the 21-day crosses above its 40-day moving average, and they both point upwards. And I'll say we have a confirmation change in trend to bullish. So the share price has recently rallied strongly above that long-term resistance around about the 370 level. And in the process, it has now closed that gap or that bearish gap. It was caused on the 21st of May. And has returned back to its, call it normal price, pre-gap price. And I was trying to find out reasons why it was a gap. I couldn't find any news on specifically why it was a gap down. But anyway, that rally has now recently tested that old support level, which is around about that 384 level, which will now act like the new resistance level. And I see that's quite a strong resistance level. So here this morning it's pulled back. The share price has pulled back 1.3%. Last I saw it was trading about 379. So a breakout, you can also see that below that where the price is trading at the moment, a breakout and close below that short-term support trend line, that ascending trend line would trigger a change in trend or the change of that rally. Saying that right at the bottom, you can see the MACD indicator. It's confirming the current bullish price action, because it's still trading in oversold territory, but it's also above its call it trigger line. So it's still very, very bullish. So on the upside, if it breaks through that, as I say, that previous support or new resistance, we could expect more resistance at between the 406 and 410 levels, and then 420. And then right up top there, you can see it doesn't even show on the chart here, but the intrinsic value is still way above there, as Fuser said, now at 461. So a lot of upside potential, and hence our buy recommendation. So it looks very positive. Cool.
Okay, thanks, Sean. Thanks, Fiso. Yeah, certainly looks bullish. I mean, there's a couple of things that need to play out for it to rally. But the facts are that if we get a favorable result from this coalition government, or maybe even a minority government, where we know that they won't be able to pull tricks without the support of the guys sitting on the other side of the aisle in Parliament, I think that'll be positive. So we're hoping for a positive outcome there, which will definitely influence all the shares on the local bourse and give us a bit of a push. Fiso's bear case shows 411 as a target, so I mean, we're trading below that. And then the technicals are showing that there's a slight uptrend on the right-hand side as well. So all in all, I think a very bullish look at Redefine Properties. Plus, they got serious quality, as Fisher has mentioned. I mean, they got a lot of good properties in Sandton and other areas. And their occupancy rates are fairly high. So it's a good property company, this, if you don't own property stocks, and especially at these valuation levels, probably worth a dip. I'm going to open the floor for Q&A. If you have any questions, you can just put up your hand. I see we're running out of time. It's already 10:02, so you can put up your hand and ask your question outright. Otherwise, I'll check the chat for those guys who've typed any questions. Clive, as usual, says thanks for the presentation. Fiso and Sean, thanks very much. Fiso, yes, it was comprehensive. Thank you. I don't see any other questions. Any last for the lasts? Oh, There's a question. Which company will be next week? Next week will be the guys with the turquoise colors riding around on scooters, making a killing out of retail. ShopRite next week. So I'm looking forward to that one because I think they are printing cash. They must be. I mean, everywhere I drive, I just have to duck for these 60 motorbike guys. So they're really doing well, I think. So yeah, hopefully next week we have positive news on the government. By that time, Redefine's rallied to at least its bear case at 411. And then we're talking about ShopRite, where we think it's a nice positive story as well. So I don't see any further questions. I'm going to close it. Fiso, thanks for your insight, mate. Good job. Nice insight there. Sean, thanks for the technicals. We'll convene next week and we'll be talking ShopRite. Have a fantastic day. Cheers, guys.
Thanks. Cheers, everyone.